My name is Vincent BRUCALES, and today we are going to talk about future arbitrage strategies. The important concepts of this lesson are future arbitrage strategies, cheapest deliver bond, and deliver options. So first, we need to know what is recall option. Recall option refers to a request by the lender to the borrower to return the loan securities. The other term is adjustment to futures price. This refers to a value that represents the cash equivalent of a futures contract. Adjusted future prices will take into account carrying costs as well as conversion factors. So, the first formula that will be introduced is how to get the invoice price. To get the invoice price, we have to multiply the settlement price on position day to the conversion factor plus the accrued interest. Second formula is how to get the cost of delivering bond. To better understand this formula, basically there are two parts of this formula. So this one is how to get the invoice price. This is the settlement price multiplied to the conversion factor plus accrued interest. And this part is how to get the forward price, which will be better understood later on. So this is the first example. On September 15, let's say 2013, they plan to deliver the 6/1/4 of May 15, 2013 on March given year contract on March 8. So the given are the settlement price, which is 140, the conversion factor, which is 1.273, and accrued interest on expiration, which is 2.890, and the other accrued interest is 1.9574. Take note that these two are different because the accrued interest on expiration means that the bond reached its maturity. That's why the interest is higher compared to this other interest. The bond cost is 148.53125. 114 days between September 15 and March 8. The reinvestment rate is 1%. First, we need to get the invoice price. Going back to the formula, so settlement price on position day multiplied to conversion factor plus accrued interest. So the settlement price is 140 multiplied to the conversion factor, which is the conversion factor, which is 1.0273 plus the accrued interest 1.9574. This will amount to 145.7794. This will be our invoice price. And to get the forward price, we have to first know the cost of the bond, which is here. Cost of the bond is 148.53125 plus the accrued interest on expiration, which is 2.0890. Then it will be multiplied to 1 plus the reinvestment rate 1%, 0.01 raised to the days between September 15 and March 8, 114 divided by the days in a year, and 365 minus the coupon. So the coupon here is 6 1/4. So to get the coupon interest, we have to divide 1 divided by 4 first. So we have to divide 1 by 4. 1 divided by 4 is equal to 1 divided by 4 is equal to 0.25, and we have to add plus 6. So in total it would be 6.25. Then we have to divide it by 2. So 6.25 divided by 2 is equal to 3.125. So this is the coupon interest. So we will put the coupon interest here, 3.125 multiplied to 1 plus the reinvestment rate points multiplied to 1 plus reinvestment rate raised to 114 divided by 365, and that will amount to 148.2058. So these are almost final answers. These two. This is the invoice price, and this is the forward price. We will subtract these two, and that is our cost of delivering. So going back to this formula, we got our invoice price minus the forward price. So the invoice price is 145.7794 minus the forward price, which is 148.2058. So it will amount to 2.43. So as you can see here, this is the computation, and the answer is 2.43. So the bond would cost 2.43 more than it would return. All we can do, however, is compare this result with that for another bond. For the 6 1/8 of November 15 given year plus 15 with a conversion factor of 1.0125 and the settlement price of 144, we have accrued interest of 2.0472 on September 15, 2011, and another accrued interest of 1.9183 on March 8. The coupon is 3.0625. It was already given on November 15, and it is reinvested at 1% for 114 days and grows to 3.0720. So we will get this by multiplying 3.06259 multiplied to the reinvestment rate, which is 1% plus 1. So 1 plus 0.01, so 1.01 raised to 114 days divided by 365, so 3.720. So to get the forward price, first we have to divide 5 by 32. So 144 and 5 divided by 32 is 0.15625. We will have to add this to 144, so 15625. This is our settlement price plus the accrued interest on expiration, which is 2.0472 multiplied to 1 plus the reinvestment rate, 1% or 0.01 raised to 175 days divided by 365 minus the coupon, which is already given here, 3.0720. So it is equal to 143.83. So this is our forward price. Now to get the invoice price, we have to get the settlement price 142 multiplied to the conversion factor here, which is 1.0125 plus the accrued interest that did not mature, which is here 1.91 plus 1.9183. That will result to 145.69. After that, this is the invoice price, and after that we will subtract both of these. To get the cost of delivering bond. So 145.69 minus 143.83 is equal to 1.86. So the problem a while ago, let's call that bond A. The cost of delivering the bond A is 2.43, more than it would return. And the cost of delivering bond B is 1.86. So comparing those two, bond B is better because bond B is better because bond A would cost more than it would return, meaning that bond B would be more profitable than bond A. So here are the computation for bond B, the forward price and the invoice price. So why identifying the cheapest to deliver bond is important. Identifying the true spot price. Spot price is the current price of a security at which it can be bought, sold at a particular place and time. And it is also important because it is calculating the correct hedge ratio. So moving on, we will now discuss delivery options. The first option is the wildcard option. Wildcard option is a type of option that is embedded in the certain treasury security. It permits the seller of a treasury bond to postpone delivery of its underlying asset until after regular trading hours. This option benefits the seller because it allows them to benefit from a few hours extra time in which to secure a favorable price. When exercising the wildcard option, the seller of the Treasury futures contract would wait to see whether the spot price declines below the invoice price during after hours of trading. If it does, the seller could exercise their wildcard option and make their delivery based on the low spot price, decreasing the overall cost of the short position.
Formula for implied repo rate is, and the meaning of each letter is C of cash flow, next T the period of time, which is the end, the small t period of time, which is the beginning, alternative mutual funds, and lastly the 1 over c. It represents the inverse of the time period to convert into a daily rate, and this is the example for implied repo rate. So compared to the actual repo rate, it notes that this is a forward rate and implied repo rate on C-band spread to Fed funds future rate. So stock index rate. So it is typically refers to the return or performance of a stock market index over a specific period. So it is also expressed as a percentage, and it represents the change in the value of the index over a specified time frame. It indicates how much the index has gained or lost during the period and provides an overview of the overall market movement. For example, si company B, nag-invest sila sa isang product na alam nila nakikita sila, pero sa katagalan din na bumababa ang mga price nung mga na-invest nila dun sa isang company. So, for example, si company A, which is his invest is up, and company B naman is down, which is the vice versa. And for example, if the stock industry is all about 5%, which is the S&P 500, for a given year, it means that the index has increased by 5% also over that year. So it indicates that the average return or performance of the stocks included in the index during that period. Next, this is the formula and example for stock index arbitrage. So next, the foreign exchange arbitrage. So it refers to the practice of taking advantage of price differences in the foreign exchange market to make a free risk profit. It involves buying and selling currencies across different markets to exploit temporary differences in exchange rates. For example, exchange rate ka ng peso to US, so yung peso is 50 pesos, and the convert from the dollar is the $1. So that's called exchange rate, or vice versa. Foreign exchange arbitrage. So we have two types of compounding. Number one, annual compounding. It refers to the method of calculating interest or investment returns on an annual basis, where the interest or returns are reinvested or compounded once per year. So it is a common approach used in various financial calculations, such as the growth of savings accounts, investments, loans, or bonds. Continuous compounding. So it is a mathematically concept used in finance and investment calculations. So it represents a method of compounding where the interest or investment returns are reinvested or compounded instantaneously and continuously over time, rather than at a specific intervals like annual, semi-annual, or monthly compounding.
Good morning, everyone. My name is YVETTE and BATALLA, and we're going to discuss about the federal funds carry arbitrage. So we have a scenario here. On March 1, the 1-month labor rate is 5.50% and the 2-month labor rate is 6%. The April Fed funds futures is quoted at 93.75, and an arbitrage opportunity is available. Contract size is $5 million, and this example illustrates the arbitrage strategy for one contract. So here in March 1, in spot market, borrow present value of $5 million at 1-month labor, which is $4,977,187.89, and lend some amount at 2-month labor. While in futures market, in March 1, sell April Fed Funds future contract at 93.75. While in April 1, in spot market, repay borrowing, which is the $5 million, pay off present value of loan. In futures market, on April 1, buy 1 April Fed Funds futures contract to offset initial futures position. The key insight is that the payoff required on April 1 of the 2-month labor loan depends on the 1-month labor rate observed on April 1. Also, we assume no basis risk between 1-month labor rates and Fed Funds futures implied rates as long as we are not in the delivery month. So to compute the loan balance due on May 1 is LB 2 equals to LB 0 1 plus R2 60 over 360. So our LB 0 here is the 4,997,187.89. 1 plus our rate is 0.06. And we will get 5,026,959.77. So here is the loan balance due on May 1. So, assuming that 1-month labor rate observed on April 1 is 7.25%, and to get the present value of the initial 2-month loan after 1 month is P1 LB 2 equals to LB 2 1 plus this is 1, okay, 360. So our LB 2 here is the 5,026,959.77. And then 1, our rate is 0.0725. Multiply by 30 over 360. And we will get 4,996,770.94. So here is the present value of the initial 2-month loan after 1 month. So assuming no basis risk, the Fed Funds futures price in 1 month is 92.75. So how did we get the 92.75? We just subtract 100 to 7.25 and we get the 92.75, which is the Fed Funds futures price in 1 month. Therefore, the gain on the Fed Funds futures contract is $4,166.67. So how did we get that? So here is the solution. So 93.75 minus 92.75 multiplied by the $5 million. Let's just put there 5M multiplied by 30 over 360 divided by 100. And if we compute that, we will get 4,166.67, which is the Fed Funds futures contract. Adding the gain on the futures contract with the proceeds from the present value of the 2-month loan, we have $5,937.61. So how did we get that? We just add the gain on the futures contract, which is the $4,166.67 plus the 4,900, this is 966,770.94, and we will get 5,937.61. Paying off the 1-month loan provides arbitrage profits of 937.61. So we just subtract the 5,937.61 to 5 million. Ay, no, 5 million pala. $5 million. And we'll get 937.61. So this is the arbitrage profits. So to get the implied 1-month repo rate, which is the 0.0573 or 5.73%. So here is the solution. We just 5,937.61 divide by the 4,977,187.89 minus 1 times 360 over 300. So if we compute that, we will get 0.0573 or 5.73%. So this is the implied 1-month repo rate. And the 1-month labor rate is 5.50%, indicating the potential arbitrage opportunity. So next is the Euro-dollar arbitrage. So we have a scenario here. On September 16, a London bank needs to issue $10 million of 180-day Euro-dollar time deposits. The current rate on such time deposits is 8.75. The bank is considering the alternative of issuing a 90-day time deposit at its current rate of 8.25 and selling a Euro-dollar futures contract. If the 180-day time deposit is issued, the bank will have to pay back. To compute that, we'll just to compute the yung babayad ng bank is the $10 million 1 plus, which is our rate is 0.0875, and yung we have 180 days, diba? Divide by 360. So if we will compute that, we will get $10,437,500. So ito yung ipipay back ng bank. The rates available in the spot and futures market are such that the bank can obtain a better rate by doing the following. So in September 16, in spot market, the 90-day time deposit rate is 8.25. Issue 90-day time deposit for $10 million. While in the futures market, in September 16, December Euro-dollar 1mm index is at 91.37. Price per $100 face value is 97.8425. So, para nakuha yung 97.8425 is 100 minus open and close parenthesis 100 minus 91.37 multiplied by 90 over 360. And price per contract is $978,425, and it sells 10 contracts. While in December 16, in spot market, the 90-day time deposit matures and the bank owes 10,206,250. So, paano nakuha yun? We use the solution. $10 million multiplied by 1 plus 0.0825 times 90 over 360. And the rate on new 90-day time deposits is 7.96. And issue new 90-day time deposit for $10,223,000. Well, in the futures market, December euro dollar 1 index is at 92.04. Price per $100 face value is 98.01. So, para nakuha yun, 100 minus open and close parenthesis, 100 minus 92.04 multiplied by 90 over 360. And price per contract is $980,100. And it buy 10 contracts. So, analysis. On September 16, the bank received $10 million from the newly issued 90-day time deposit. And on December 16, it bought back its 10 futures contract at a loss of 16,750. So, paano natin nakuha yung 16,750? So, here is the solution. 10 multiplied by 980,100 minus 978,425, and we will get 16,750. And it issued 10,223,000 of new time deposit using 16,750 to cover the loss in the futures account, and the remaining 10,206,250 to pay off the maturing 90-day time deposit. On March 16, it paid off the new time deposit owing $10,426,438. So how did we get the $10,426,438? So here is the solution. So 10,223,000 1 plus 0.0769 multiplied by 90 over 360, and we will get the 10,426,438. So here is the new time deposit owing 10,426,438. Thus, on September 16, it received $10 million, and on March 16, it paid out $10,426,438. It had no other cash flows in interim. Thus, its effect borrowing cost for 180 days was 0.0884. So how did we get 0.0884? So here is the solution to get the 0.0884. The 1,426,438 divide by the $10 million. Let's put dollars. Raised to the power of 365 over 180 minus 1. And we will get 0.0884. Which is 23 basis points less than the cost of a 180-day Euro-dollar time deposit. Next is stock index arbitrage. So we have a scenario here. On November 8, the S&P 500 index is at 1,305. The continuously compounded dividend yield is 3%. And the continuously compound risk-free rate is 5.2%. The December futures contract, which expires in 40 days, is priced at 1,316.30. So to find the theoretical price is F over 1,305 E is to the power of 0.52 minus 0.03 multiplied by 0.1096. And paano natin nakuha ito? We just divide 40 over 365. So if we compute that, we will get 1,308.15. So this is the theoretical price. And thus, the futures contract is overpriced and the carry arbitrage transaction will be executed using $20 million. Transaction costs are 0.5% of the dollars invested. So we have here in November 8, the S&P 500 is at 1,305. The stocks have a dividend yield of 3%. The risk-free rate is 5.2%. So buy $20 million of stock in the same proportion as make up the S&P 500. While in the futures market on November 8, the S&P 500 futures expiring on December 18 is at 1,316.30. The appropriate number of futures is $20 million, which is 61.30. So, para nakuha yung 61.30 is $20 million divided by 1,305 multiplied by 250. And it sells 61 contracts. While on December 18, the S&P 500 is at 1,300.36. The stocks will be worth $19.92889 million. Kaya nakuha yung $19.92889 million is we just multiply the 1,300.36 over 1,305 multiplied by $20 million. And the $20 million invested in the stocks effectively costs $20.048242 million. So, paano natin nakuha yung $20.048242 million? We just multiply 20 million e raised to the power of 0.52 minus 0.03 multiplied by 0.1096. And we'll get the $20.048242 million. And transactions costs are $100,000. So we just multiply $20 million to 0.005 and we get the $100,000. It includes in futures cost. So while in December 18 in futures market, futures expires at the S&P 500 price of 1,300.36 and close out futures at expiration. So analysis, profit on stocks, which is $119,393. So paano natin nakuha yon? So here is the solution. We just subtract the receipt from sale of stocks, which is $19,928,889. So subtract natin siya sa invested in stocks, which is the $20,048,282. And we will get the $119,393. Pero this is negative. So next is the profit on futures, which is $243,085. So paano natin nakuha yan? So ito yung solution. 61. So we'll just subtract the sale price of futures, which is 61 multiplied by 250 multiplied by 1,316.30. Subtract natin sa purchase price of futures, which is 61 multiplied by 250 multiplied by 1,300.36. And pag kinumpit natin yan, makakukuha natin yung $243,085. So our overall profit is $23,692. So paano natin nakuha yon? So pinag-add muna natin yung dun sa futures, which is $243,085. So ipag-add natin yung sa futures tapos yung sa stocks. Pero syempre, 'di ba negative yung sa stocks natin, so magiging minus 'yon. So magiging 119,393. So tapos i-minus din natin siya sa transaction cost, which is the 100,000. Tapos pag kinumpit natin yan, makukuha natin yung 23,692. So the appropriate number of futures contracts to match $20 million of stock is $20 million divided by the index price, not the future price, times the multiplier. Even though the $20 million is allocated across 500 different stocks, it is equivalent to buying 15,326 shares of the S&P 500. So paano natin nakuha yung 15,326 na shares? We just divide the 20 million divided by 1,305 equals to 15,326 na shares of the S&P 500. The appropriate number of futures is 1 for each equivalent share of the S&P 500. Each futures, of course, has 250 multipliers. So each futures has 250 multiplier.